Assalamualaikum warahmatullahi wabarakatuh. I'm with Madam HUSNA and my fellow friends. So today, me and my friends, we will share our answer on the question from group assignment semester September 2017 to January 2018.
I'm NURSHUHADA binti Rani. I will share my answer for the question number 1.
Okay, for question number 1, on 1st July 2015, Evergreen Berhad acquired a building at cost of 2 million. The economic useful life of the building was estimated to be 50 years. Evergreen Berhad has been using the building as its staff training center. The fair value of the building on 1st July 2016 was 2.058 million. It's the policy of the company to measure its PPE using revaluation model and the investment property by using fair value model. Accounting year end on 30th June. So the question asks for the discuss the accounting treatment of the building for the year ended 30th June 2016 and for the 30th June 2017. So since the company is acquired on a building on 1st July 2015, so this is the date of acquisitions, and the initial cost of the building is 2 million, and it has 50 years economic useful life, and it is the PPE because the building is used for the staff training center, which is owner occupied property, and there is fair value, the initial fair value for the building on 1st July 2016. Okay, so let's see the accounting treatment for the building. Okay, here is my answer for the question number 1A. Okay, first of all, I will start with the calculation. Since the building is the PPE because it is used as the staff training center, so the PPE is using revaluation model. So on the 1st July 2015, this is the initial cost of 2 million. And we will calculate the depreciation for the asset for the building, which is we will get 40,000. From there 2 million divided by 50 years. Okay, on the 1st July 2016, the carry amount of the building is 1.96 million. And there is fair value, initial fair value for the building, which is 2.058 million. And we will get reversion surplus of 98,000. And on the 1st July 2016, we will use the deemed carry amount at the fair value, which is 2.058 million. And to calculate the depreciation, we will take the amount of fair value divided by 50 years minus 1 year, which is the 1 year that we have used the previous accounting period. Since this is the first accounting period and this is the second accounting period, and the carry amount at the date of 30th June 2017 is 2.016 million, and the depreciation for the year is 42,000. Okay, for the accounting treatment for the year ended 30th June 2016, first of all, on the 1st July 2015, the building should be recognized as PPE, as plant, property and equipment, as accordance to MFRS 116, and measured at initial cost of 2 million as the building is used as staff training center. And the depreciation charge of the year 2016 is RM 40,000. And the carry amount as at 30th June 2016 is at RM 1,916,000. This is the accounting treatment for the year ended 30th June 2017. Okay, the carry amount as 1st July 2016 was RM 1.960 million. And on the 1st July 2016, there is also surplus on evaluation of 98,000. Which is we also be credited to the asset valuation reserve since the company is adopting revaluation model for PPE. Okay, the accumulated depreciation of RM 40,000 will be eliminated from the plant, property and equipment. Okay, next the fair value of 2.058 million as the date of 1st July 2016 is deemed to be the carrying amount of the building, and the depreciation as at 30th June 2017, it will be RM 42,000. The calculation, you can refer to the previous calculation that I explained just now. And the depreciation will be expensed off to SOPR. And lastly, the carry amount of the building at 30th June 2017, it will be at 2.016 million, which is the difference between the fair value minus the depreciation for the year. Okay, next is question 1b. Assuming on 1st July 2016, Evergreen Berhad has decided to lease out the building to a tenant under operating lease. Fair value of the building on 30th June 2017 was 2,158,000. Discuss the accounting treatment for the building for the year ended 30th June 2017 and support your answer with the journal entries. So here we can see that on 1st July 2016, Evergreen, there is a change in use because the company has decided to lease out the building to a tenant, which is the third party. Thus, this is fall under investment property. Thus, thus there is a transfer from PPE to IP. So here is my answer calculation for the answer question number 1b. From this part, this is just the same with the previous, so this part, okay, this part it will same as the previous answer. Okay, the difference is start from here. Okay, before this we'll accounted fair value as the revaluation surplus. This is the model. There's nothing change in use, it's just under PPE. But however, this question there's change in use, which is PPE to IP. So we need to recognize the fair value on the date of transfer, which is 2,058,000. So here it will be the deemed carry amount for the investment property. So we get the same amount, the reversion surplus of 98,000. Okay. Since the investment property is using the policy of fair value model, so on 30th June 2017, there is another fair value, which is 2,001,058. And one more thing, under fair value model, under investment property, there is no depreciations. We need to remember that under fair value model, for the investment property here, there is no depreciation. Okay, we need to remember this because from the other part, for the PPE or even for the IP or for cost model, everything will calculate the depreciation, but except for the investment property for the fair value model. So, the difference between these two, it will get 100,000 of fair value gain. Okay, next is for the accounting treatment. Okay, on 1st July 2016, there's a transfer from plant, property and equipment PPE to investment property because there's a change in use from owner-occupied property to rent out under operating lease, which is owner-operated property is when it is used for the staff training center, and next it will transfer to the rent out to the tenant. And second, carrying value of PPE on the date of transfer is RM 1,916,000 and the accumulated depreciation of RM 40,000 will be eliminated. The difference of carry amount and fair value resulted in surplus on revaluation of RM 98,000 and it will be recognized and credited to asset evaluation reserve. And the fair value of RM 2.08 million as at the date of transfer is deemed to be the carrying amount of the investment property. Since the IP is using fair value model, thus there is no depreciation will be provided. This one is so important because only under fair value model, under investment property that no need to calculate the depreciation. Because for the PPE, even the PPE under revaluation or even cost model, we will calculate depreciation, and also under investment property for the cost model, we will also calculate the depreciation for the year. And lastly, as for the year ended 30th June 2017, there's a gain on fair value of RM 100,000, as the fair value is higher than the deemed carrying amount and will be recognized as other income in SOPL. So here is the fair value, and this is the deemed carrying amount since it is higher by RM 100,000. Okay, now I will share about the journal entries. Okay, on the 1st July 2016, which is the date of transfer, so we will debit MFRS investment property, which is we will recognize, and credit our MFRS 116 plant property and equipment, which we will be recognized. For investment property, we will recognize at fair value, which is 2.058 million, and the PPE we will do recognize at cost, which is 2 million, and we also debit accumulated depreciation, which is the elimination for since we transfer from the PPE to IP. Thus, we need to eliminate all the accumulated depreciation for the PPE. And credit ARR, which is surplus on evaluation, which we get from the surplus on evaluation by comparing the difference between the fair value and the carry amount as the date of transfer. So we get the surplus on valuation of 98,000, while for the eliminated of accumulated depreciation, we will debit 40,000. And next, for at the 30th June 2017, we'll debit investment property and credit SOPL gain on fair value, since the difference between the carry amount and the initial revaluation for the investment property, we will get the difference of 100,000. Okay, that's all for the question 1. Thank you.
Assalamualaikum and hi. My name is NURSHUHADA HUSNA binti Muhammad ROSLEY and I'm from AC 1105M. Today I'm going to share my answer on question 2. Vista Berhad bought an asset at the cost of RM 75,000 on 1 July 2016. On 30 June 2017, similar asset had been actively traded in the market at RM 85,000. The cost to sell is RM 2,500. Assuming the asset is scattered reared for its mates. Explain the appropriate accounting treatment of the asset for the year ended 30 June 2017. On 1 July 2016, the asset is recognized as biological asset as per MFRS 141, as it is a living animal and the asset is cattle reared for its meat. The asset is initially measured at cost of RM 75,000. Consequently, changes in fair value of the asset will be recognized in SOPL. The gain on changes of the fair value of RM 75,000 is credited as income in SOPL for the year ended 30 June 2017. The amount of 7,500 can be calculated by 85,000 minus 2,500 and minus 75,000. The fair value less cost to sell of the asset on 30 June 2017 is RM 82,500. Next is junior entry for the translation in A1. Firstly, we will debit biological asset at RM 75,000 and we will credit the bank or account payables at RM 75,000. Next is there changes in gain in fair value. So we will debit biological asset RM 7,500 and we will credit SOPL gain in changes of fair value RM 7,500. Question 2b. Assuming the asset is equipment used in research activity, which has an estimated useful life of 5 years and the cost model is adopted, explain the appropriate account treatment of the asset for the year ended 30 June 2017. So the answer is, on 1 July 2016, the equipment purchased for the use in research activity, which is RM75,000, should be treated as property, plant and equipment in accordance with MFRS 116. Since the company used the cost model, the carrying amount of the equipment on 30 June 2017 will be measured at cost less accumulated depreciation less impairment loss RM60,000 in soft pay. The depreciation of the equipment amounted RM50,000 should be expensed off to soft P as part of research costs. Thus, the deemed carrying amount for the asset as at 30 June 2017 is RM82,500. The journal entries to record the above transaction in B1 is we will debit property, plant and equipment RM75,000 and we will credit bank or account payables of RM75,000. Next, we will debit depreciation of RM15,000 and we will credit accumulated depreciation RM15,000. That's all from me. Thank you.
Assalamualaikum. I'm Shazana binti Rani. I will share my answer for the question number 3. Okay, for the question number 3, Crescent Berhad acquired an asset on 1st July 2016 for RM800,000. The useful life of the asset is estimated to be 50 years. Fair value of the asset given by an independent valuer on 30th June 2017 was RM918,000. For the subsequent measurement, the company adopts the following model for its asset, which is investment property is adopts a fair value model, PPE is using revaluation model, while intangible asset is using cost model. And the question asks to discuss the accounting treatment asset for the year ended 30th June 2017, which assuming the asset was a building rented out to Crescent Berhad subsidiary company. Okay, based on this question, since the building is rented out means it is under IP. So but however it is it is rented out to subsidiary company. There is another special treatment for this subsidiary company. So we will refer to the slide number 6 for the MFRS 140 investment property, which is it stated that properties within a group, property owned by a company and occupied by the parent or subsidiary, will be classified as PPE in the consolidated financial statements, while it will classify as investment property in the financial statements of the company that owns the property, which is the Crescent Berhad. So let's see the accounting treatment for the year ended 30th June 2017. For the question A. Okay, so here is the answer for the question number 3A. Okay, we start from the calculation. Since the building is under the investment property and using fair value model, so on the date of acquisition, on the 1st July 2016, we recognize the initial cost of 800,000. And at the 30th June 2017, there is fair value, which is 918,000. And the difference between these two figures will produce gain on fair value, since the fair value is higher than the cost. So we get the gain on fair value of 118,000. So let's see the accounting treatment. MFRS 140 stated that the property rented out to a parent or subsidiary will be classified as plant property and equipment PPE in the consolidated financial statements. Meanwhile, in the Crescent Berhad financial statement, which is the company that owns the property, it will classify as investment property. Thus, on 1st July 2016, Crescent Berhad will recognize the building as investment property, as according to the MFRS 140. at initial cost of Rm 800,000 and as it is rented out to the company's subsidiary. And next, on the 30th June 2017, the company adopts the fair value model. Thus, it should recognize fair value gain of Rm 118,000 as part of other income in the SOPR for the year ended 30th June 2017, as the fair value of Rm 918,000 is higher than the cost of Rm 100,000. And the building is shown in the SOFP as at 30th June 2017 as investment property and is measured at fair value of Rm 918,000. Okay, next is the question 3b. Discuss the accounting treatment of the asset for the year ended 30th June 2017, assuming the asset was a building provided by the Crescent Berhad as housing facility to the foreign workers. So, this is classified under PPE because it is owner-occupied property. Okay, here is the answer for the question 3b. So, we'll start from the calculation. Okay, since the building is the PPE, so it will use evaluation model. Okay, we start at the date of acquisition, which is at cost 800,000, and the depreciation is 16,000, which is 800,000 divided by 50 years, the economic useful life of the building. And at the 30th June 2017, the carry amount is 784,000. And there's also the fair value. The fair value is at 980,000. Thus, the difference between these two figures it will result in the revaluation surplus of 196,000. So the deemed carry amount will be at 980,000. Okay, next is the accounting treatment. Okay, on the 1st July 2016, Crescent Berhad should recognize the building as PPE as according to MFRS 116 at initial cost of 800,000 since it used as housing facility to foreign workers. The depreciation charge as at 30th June 2017 is at Rm 16,000 and will be expensed off to the shopper. So the carry amount as at 30th June 2017 it will be Rm 784,000. On 30th June 2017, there is a surplus on evaluation of Rm 196,000 since the company adopts the revaluation model and the amount will be credited to the asset evaluation reserve. And the accumulated depreciation of Rm 16,000 will be eliminated and the fair value of Rm 980,000 as at 30th June 2017 will be deemed carrying amount of the building. Okay, next we move to the question 3c. Assuming that the asset above was a license and on 30th June 2017 there is a recoverable amount of Rm 700,000. So first we need to calculate the impairment loss and the second prepare the journal entries on the impairment loss. Okay, here is my answer for the question number 3c. First of all, we need to calculate the impairment loss. Okay, as the question stated just now, it said that assume that asset is the license. Okay, the license is under the intangible assets. Okay, we'll start from the 1st July 2016. So the initial cost of the license of the asset is 800,000. Okay, the amortizations. Amortization is just the same as depreciation, but for the intangible, we will call it as amortization. The depreciation, we will use it for the PPE and IP. Okay, for the amortization, we will get 16,000. Okay, this is derived from the 800,000, which is the initial cost divided by economic useful life of 50 years. Okay, yep. Okay, for the 30th June 2017, the carry amount of the asset is 784,000. Okay, for other than that, on the 30th June 2017, there's also recoverable amount, which is 700. So we will compare these two figures. So since the recoverable amount is lower than the carry amount, then there is a impairment loss of 84,000. So, the impairment loss of license as at 30th June 2017 is RM 84,000. Okay, next is we need to prepare the journal entries on the impairment loss. So, since the impairment loss is happened on the 30th June 2017, so it will debit super impairment loss 84,000 and credit accumulated impairment loss all license of 84,000. Okay, that's all from me for the question number 3. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is NORSYAZRIENA NAJWA binti SAIDAN. I am from AC1105M. So for today, I will presenting for question 4 and 5. Okay, so let's go for question 4. On 1 July 2016, the plant property and equipment ledger of Crimson Berhad show the following balances. Plant at cost 12 million and accumulated depreciation 4.8 million. It is the company policy to provide depreciation on plant at 10% per annum on yearly basis. The following information was made available during the year. So for the question A, on 1 October 2016, one of the plant component was replaced, but it was only to restore the plant to its previous condition. Replacement cost was 65,000. So the requirement for the question is explain the accounting treatment for transaction in A. So the answer is, on 1 October 2016, the replacement cost incurred by the company can be classified as revenue expenditure. The replacement cost costing of 65,000 should be expensed off to statement of profit or loss as an expense. This is because the replacement cost was only to maintain the plant beyond its existing working condition and in its intended manner without enhancing the future economic benefit of the plant. The reason I'm saying this because the replacement cost didn't increase the production capacity of the plants. So the replacement cost cannot be capitalized and added to the soft P. Okay, so for the question B, on 30 June 2017, one of the major components of plant was replaced by Crimson Berhad, which put the plant in a better operating condition and extend its useful life. Replacement cost was 500,000. The old component was purchased on 1 July 2013 at the cost of 350,000. So, prepare the journal entry to record the transaction in B. So before we do the journal entry, let's do the working first. So we already be given the cost of the plant in the question, which is at 12 million. And then we will minus with accumulated depreciation to find the carrying amount as at 30 June 2017. So the accumulated depreciation is 4.8 million. 12 million multiplied with 10% because the company's policy to depreciate its plant at 10% per annum yearly basis and will be multiplied with 4 years because from 2014 until 2017. So the carrying amount as at 30 June 2017 is 7.2 million. So since there's a cost of new component, we will add the cost of new component because the cost of new component can be capitalized at 500,000 and will be minus with carrying amount of the old component 210,000. So we will get the new cost of the plant is 7,490,000. So how do we know the carry amount of all components is 210,000? So this is the workings. The question gave cost of all component at 350,000. So minus with accumulated depreciation, the cost 350,000 multiply with 10% and multiply with 4 years, we will arrive the accumulated depreciation 140,000. So 350 minus with 140,000, we will get 210,000 for the carrying amount for the old component. Okay, so the first journal entry is to recognize the cost of all components. Sorry, this is cost. So the journal entry, we will debit accumulated depreciation 140,000 because this is to show the elimination of accumulated depreciation. And then we will debit SOPL loss, which is this is the cost of carrying amount 210,000, and credit plan, the cost of the old component 350,000. The second journal entry, we will capitalize the new component, which is debit plan 500,000 and credit bank or payables 500,000. Okay, then for question 4, let's go for question 5. So for question 5, a property development company, Damai Berhad, had completed the development of 20 units of shop houses on 1 July 2015. Each unit cost at 750,000. On 30 June 2017, the market value of each unit was 1 million. The policy of the company is to measure its investment property using fair value model, and for property, plant and equipment using revaluation model. So the financial year end on 30 June each year. So to answer the question A, assuming the 20 units of shop houses are for sale in the ordinary course of business, on 30 June 2017, there were 3 units remain unsold. So the question is, identify the MFRS used and explain the accounting treatment of the unsold unit in accordance to the relevant MFRS. Okay, so the first question, identify the relevant MFRS use. So this is MFRS 102 inventories because it is used for the sale in the ordinary course of business. So the second question is about the accounting treatment. So we will find first the cost of the inventory, which is the question give the cost at 750,000 and we multiply with 3 units. Why 3 units? Because this is the units of inventory. The 3 units remain unsold. So we will get the cost of inventory at 2,250,000. And then the net realizable value is at 1 million multiplied with 3 units. So why 1 million? Because this is the market value of the inventory, which is net realizable value stand for estimated selling price less cost to sell or market value. So we will get 3 million for net realizable value. So the accounting treatment is the unsold unit of shop houses can be classified as an item of inventory for Damai Berhad. According to MFRS 102, inventories are assets held for sale in the ordinary course of business, in the process of production, for such sale, or in the form of materials or supplies to be consumed in production process or in the rendering of services. So inventories shall be measured at lower of cost and net realizable value. Thus, the value of inventory in this case is measured based on cost, that is 2,250,000. That is to be shown in SOPI. So we choose this cost because this is the lower between the cost of inventories and net realizable value. Okay, so for the last question is question 5B. Assuming that 70 units of shop houses are rented out and the other 3 units are occupied by Damai Berhad, each unit could be sold separately. Explain the accounting treatment for the shop houses for the year ended 30 June 2017. Okay, so since the question stated that it can be sold separately, since the shop houses can be leased and sold out separately, Damai Berhad should accounted the shop houses for separately. The 70 units of shop houses that are rented out can be classified as investment property as per MFRS 140 and measured at initial cost of 12,750,000, which is 750,000 multiplied with 17 units of the shop houses. So, since the investment property adopts fair value model, thus no depreciation shall be provided. Any changes in fair value resulting of gain or loss will be recognized in the statement of profit or loss. Okay, let's go for the remaining of the 3 units. So, the 3 units of shop houses that are occupied by the entity shall be treated as PPE, owner occupied property, under MFRS 11C at a cost of 2,250,000. 750,000 multiplied with 3 units. So since the company adopts revaluation model in valuing their PPE, the carrying amount should be calculated based on cost less any subsequent accumulated depreciation and any subsequent accumulated impairment losses. Okay, so I guess that's it from me. Thank you.